Good day to all. This is our discussion involving depletion of mineral resources from IFRS 6, which is our accounting standard to be used for our discussions. So for this one, we have to take note of the learning competencies. And then let us just also take note that our standard is PFRS 6, Exploration for and Evaluation of Mineral Resources. At the end of this particular lesson or course, we should be able to do the following. Explain the accounting for costs of exploration for and evaluation of mineral resources, identify the cost of a natural resource, and account for the depletion of a natural resource. So let's begin. Exploration and evaluation expenditures can basically happen before we are able to establish the technical feasibility and commercial viability of such. If we say technical feasibility, it means that at that point in time, we are able to demonstrate that if we are going to extract the mineral resources, then our efforts will result to commercial activities. So meaning to say, whatever we do on that particular, at that point in time, like the extraction of the mineral resources again, the production of such, and all other activities related to mining at that point in time will contribute for us to be able to really sell such products. And the expenditures, of course, will have to be the cost associated with such, but that's prior again to technical feasibility and commercial viability. The activity is called exploration for and evaluation of mineral resources, which is also the title of our accounting standard, which is PFRS or IFRS 6, is a search for mineral resources, including minerals, oil, natural gas, and similar non-regenerative resources. If we say non-regenerative, that means non-renewable, non-replenishable, or basically cannot be renewed. That's the better term. Cannot be renewed anymore. We can no longer get back or return whatever has been extracted or used of. Resources after the entity has obtained legal rights to explore in a specific area, as well as the determination of the two items we mentioned a while ago, technical feasibility and commercial viability of extracting the mineral resources. Also, we have to take note again that the activities, of course, are to be done after we have obtained the legal rights. This is very important. Before we are going to drill, make holes of certain land, mines, or areas, it should be that we are able to comply all the requirements required by the government. Otherwise, the opposite can happen, which would be illegal activities. The expenditures, of course, as explained, are expenditures incurred by an entity in connection with the exploration for and evaluation of mineral resources before the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. As said, this is prior to those 2 points in time. Now, in terms of our accounting policies, let us just take note that PFRS 6 is not yet able to provide us really the specific treatment for that. In fact, it's like an open area wherein a certain entity is allowed to develop their own accounting policy or policies for exploration and evaluation assets, which results in relevant and reliable information based entirely on management's judgment and without the need to consider the hierarchy of standards in PAS 8. So if we can recall, we've discussed actually that standard. I'm talking about the latter one, PAS 8, that has the title Accounting Policies, Changes in Accounting Estimates and Errors, which would account for all the changes of accounting policies and estimates of the company. Of course, there would be a hierarchy of what should be the way. In fact, that's also tackled or discussed under PAS 1, Presentation of Financial Statements, and also with our conceptual framework. So in that sense, it's clear that there's really a level. So remember, we are going to make use of the specific standard. That's our number one. Second, other accounting standards that tackled or that discussed about such items. That's a possibility that there are also accounting standards that may be mentioning about the item that we are referring to. In the absence of those two, remember we are going to make use of the management's judgment about the situation. So that's the hierarchy that we are talking about. In this case, it's clear that management can use its judgment and without the need for the hierarchy. Next is that this would mean the entity may recognize these expenditures as either as expense or asset, depending on the entity's own accounting policy. And we refer also to our recognition principles to expense or asset respectively, and how do we record them? How do we actually process them to become part of our financial statements? Expense, of course, will have to affect the profit or loss, and asset, of course, on the statement of financial position, and will have impact as we amortize or depreciate such. And that's why if assets, meaning to say these costs are capitalized, we have to measure them at cost. And later on, if we are going to, of course, use the asset method in which we are going to capitalize, so it's similar to PPE, wherein we are going to make use of cost model or the revaluation model. Under IAS or PAS 16, property, plant, and equipment, for cost model, we are going to present such items at cost less accumulated depreciation and accumulated impairment losses, which is also true for evaluation model, except that the latter model will present the amounts at replacement cost or fair value respectively. All right. Next would be natural assets or natural resources, also known as wasting assets. These assets are non-renewable, non-regenerative, non-replenishable, which would include petroleum, minerals, and timber. They have two main features: the complete removal or physical consumption of the asset. Once we extract them, then that's it. There's no way that such will grow again, just like with some living plants, of course. And the replacement of the asset only by an act of nature. There could be another possibility, but only the nature can do the course. The cost of natural resources would include the following: the usual purchase price or acquisition cost, including our directly attributable costs, which are, of course, needed items, including the legal fees, the permits needed for us to be able to make use of the land and the mines and the area, and restoration costs. We have to be in accordance and we have to be in adherence to the government requirements. There is really a great possibility that we will be required to return or restore the area that we use in mining operations to its normal or original condition. And just like with dismantling costs for machine in property, plant, and equipment, restoration costs will have to be capitalized and will be recorded or capitalized at present value with a certain discount rate. So discounting is important here of the cash flow. Next would be the expiration and evaluation costs, to the extent that they are capitalized in accordance with the entity's accounting policy. So costs and expenditures, whether asset method or expense method, will have to be used. Number 3 would be the development costs. These are the amounts paid to prepare the resource site for mining. We develop the area so that we will be ready for the operations, and would include drilling costs, cost of construction of tunnels, which are really going to change the landscape of the area, shafts, and wells. So we are going to dig deeper, and then tunnels are to be made accordingly. Just like what we have seen in some movies or shows. Depletion is the way to allocate, and that is a systematic and rational allocation of the depletion base of a natural resource over the period the natural resource is extracted. If we say that depreciation is the systematic and rational cost allocation of property, plant, and equipment, depletion is for the wasting assets. Depletion base is the capitalized cost of the natural resource less its residual value, also known as salvage value or scrap value, which is the amount by which the natural resource can still be sold at the end of the estimated life or term that such resource can be extracted. Now, depletion base is also known as depletable amount. If we have depreciable amount, which is cost less salvage value for property, plant, and equipment, we also have the depletable amount or the depletion base for wasting assets. In terms of method, normally we will make use of the units of production method, also known as activity method, or is part of the variable charge method. So here's the good thing for depletion. We only make use of one formula as a rule. There can be a mention of a straight line, but that would be for another occasion or separate occasion. So normally, units of production. The challenge here is to estimate how many units can be expected to be produced or extracted from the source or from the mining area or source. And in that case, because that is an estimate, estimates can also change over time and would have impact on our depletion. Remember also for the computation of that, we are going to determine again the revised remaining number of units to be extracted or produced at the end of the accounting period. So let's check if there would be changes. Anyway, for PPE items like mining equipment, which will be used for the operations here in mining industries, we can classify them into movable, tangible, and immovable tangible. So take note that if we say equipment, these really are tangible items of PPE. If movable, those that can be used from one extracting site to another. So literally, the movable word is having the literal meaning. Heavy equipment, transportation equipment, for example, they can be moved from one area to another. In that case, we are going to use the normal depreciation policy, and we are going to depreciate over its useful life. So that particular policy later. Letter B, immovable tangible equipment, those that cannot be used in other extracting sites after the reserves in one site are fully depleted. So example for that would be the drilling rig foundation. So in that case, we can no longer remove that from the area. And we are going to depreciate it over its useful life or the life of the resource, whichever is shorter. Since normally, if the life would be shorter, then no problem. The cost will be exhausted or will become zero, or the salvage value, if considered, would be equal to such. However, if the resource is shorter, so there would be a problem. So at least because we can no longer make use of that after the term or the time of the respective mining operations. So if that is the shorter one, at least the cost has already been depreciated or exhausted. Now, important points. When the useful life of immovable tangible equipment is shorter than the economic useful life of the natural resource, then we use the straight line method, because the key here is that it's the useful life that is being taken into account of the equipment. Therefore, use the method that is the usual straight line. But if we are going to refer to the term or economic life of the natural resource, and that would be the shorter one. So the useful life of the equipment is longer than the economic useful life of the natural resource, meaning the latter is shorter than the former. Then we use the method that is usual also for the natural resource or wasting asset or assets, in which that is the units of production method. Now for letter A, we really have to make use of the method that we are allowed to use depending on the consumption of the economic benefits. Straight line method is also okay or fine. And that will be the end of our discussions. Depletion of natural resource is really quite a short source and standard. And with that, thank you very much for listening. Please stand by and stay put for further updates involving intermediate financial accounting and reporting. And God bless us all always.